Good afternoon, ladies and gentlemen. This is Robert Rayburn. It is October 28th, 2021. Pretty crazy to think that we're almost at the end of the year. But before we get started, I just want to thank everyone for attending this week's episode. And we know that this year's had a lot of ups and downs. But as the Delta variant cases have come down, we think now the portfolio is not only on the right track, but we're properly positioned for what we think is a secular move into the value portion of the stock market. So today, what we're going to focus on is making money. And how do we make money in an environment where long-term interest rates are potentially on the rise, where the Federal Reserve is becoming more restrictive in terms of its supply of money? And more importantly, how do we navigate pockets of the market that may be a little bit overvalued versus other areas that are undervalued while keeping a long-term focus? So we're going to go through all of that today. So I'm going to go ahead and share my screen. And as you can see here, the title of that presentation is Focusing on Making Money. And why did we create that title this week? We know that if we go across TV, radio, internet, blogs, etc., everyone has an opinion, but no one is held accountable for their advice unless you're dealing with an advisor, a portfolio manager, such as myself. We're held accountable every single day. Every week that we send out one of these updates, every day that we're speaking with clients, we have to show them the results. The great thing about being a blogger, about being a commentator on TV, is that you're never really held to account for a lot of the value destruction that is delivered to people watching or reading their programs. And so today we're going to focus on three things. We're going to focus on reviewing the track record of the media over the past decade. I think that's important. Let's hold these people accountable. Number two, using the stock market to gauge what area of the business cycle are we in? Are we early cycle, mid cycle, late cycle? And then how do we execute on portfolio management based on having some idea as to where we are in the business cycle? And then lastly, do energy stocks have more gas left in the tank? And obviously that's kind of a funny pun, but it's important. It's a big overweight in the portfolio. So not only do we want to obviously be positioned in energy when it's going up, but as it's going up, we want to understand at what point does it become overvalued, and at what point do we want to bring down that exposure? Hint, hint. The answer is not yet, and not now, and not. We don't think we're anywhere close to that point. But it's important to constantly hold our trades accountable. So I'm going to move on here now. Pontification just quite simply doesn't make money. And the reason why we're bringing this up is that this week, one of the big headlines out there was that Jack Dorsey, the CEO of Square and Twitter, sent out a big tweet that kind of got global coverage, which was hyperinflation is going to change everything. It's happening. No, it's not. It's not happening. We have inflation. We have 3 to 4% inflation. We see it in the goods that we buy. It's how the portfolio is designed right now to prosper and profit off of inflation, but it's not hyperinflation. If you want hyperinflation, speak to people from Venezuela, speak to people from Zimbabwe. They will tell you what hyperinflation looks and feels like and how it impacts their lives. So it's kind of a ridiculous thing that is put out there. In fact, we would say it would be great if Jack Dorsey would spend a little bit more time focused on managing Twitter and Square, as those stock prices have gotten clobbered over the last few months as the business outlook has deteriorated for those particular companies. Now, why is it not hyperinflation? Well, if we look at the chart here on the charts on the right, what we see are two things. First of all, asset and labor utilization is still only around 75%. To get a true inflation spiral like we saw in the 1970s, you truly have to exhaust all labor supply. Now, yes, there's a lot of people that are voluntarily out of work, and that is causing some wage inflation. But to have that wage spiral, you quite simply have to run out of people, because right now we have voluntary people that are out of the labor pool. Raise wages high enough and those people will come back in. When you simply run out of people, that's where you start to get that wage spiral that's a little bit out of control. So again, asset utilization, labor utilization, which is only around 59%, we can see here on the bottom right chart. Just as these are charts that don't indicate anything that would come even remotely close to hyperinflation. Now, I put this chart first for a particular reason, because this is a great example of the media going out there, pushing a narrative, pushing a storyline that scares us, that scares people. We get calls as a result of these headlines, and it's natural. If I were in a client's shoes, I would be doing the same thing. But then let's look at the media and their track record. Quite simply, we need to turn off the media. It's the best investment decision that I can provide. Forget stock picking, forget asset allocation, forget market timing. Turn off the media. And I understand it's kind of a catch-22 since we are communicating through media. But the point here is that mass media they sell ads through fear. Now, if you look here, whether it was the BP oil spill or the flash crash, the European debt crisis, multiple US government shutdowns, the Ebola virus, an earnings recession, NASDAQ 100 falling 4% on one given day, the trade war, Delta variant, the actual COVID outbreak in March of 2020, supply shortages, inflation. There's one common element here. All of these, and there's probably close to 50 events here over the last decade, they've all done a very effective job at scaring clients out of stocks. And they've also done a very effective job of depressing client returns. Because every time you sell, guess what? You're missing the next leg higher in the market. Recessions kill bull markets, not these events, not these headlines. I spend so much time on this. We as a firm and our advisors spend so much time on this because stock picking is great and it's our passion. But if we can't help clients ignore the media, that's the number one detractor from long-term performance. That's what's going to set you short for your long-term investment goals. We need to turn off the media. So what is the market telling us right now? We believe in symptomatic investing. Forget pontificating about what's going to happen over the next 20 years. What is the market telling us today? What do we know to be true? Well, we know that energy, consumer discretionary financials, materials, industrials are the leading sectors. And what's funny about, if we look at 1, 2, 3, 4 of 6 of the leading sectors, 4 of them are early cycle sectors. The top 3 performers, financials, energy, and consumer discretionary, are early cycle sectors. So from a symptomatic standpoint, that tells us we are in an early cycle market and an early cycle economy, and that we should position and invest as such. And that's how we are positioned. That's how we are invested. We are overweight energy, consumer discretionary, and financials. Yes, GDP has come down in Q3. That's because of the Delta variant. If we look at a lot of our leading indicators, we're expecting a really strong Q4, and you're starting to see it play out in the stock market in terms of what's performing and what's not performing. So what happens during reflation cycles? Quite simply, interest rates move up. That's a good thing. That's a sign of health. We don't want interest rates at 0. We don't want interest rates negative. That's a sign of a sick economy. We want a healthy economy. So we want it to reflate. We want to bring all boats up, and we want those long-term rates to gradually increase. And so as a result, as interest rates move up, the distribution of growth expands to more and more companies. It's not found in just 5 companies across FANG. It's found across 400, 500 different companies across the stock market. As a result, value starts to outperform growth. And what we mean by that is that companies that can't necessarily grow in a low growth environment start to grow. And therefore, as investors, we don't have to hold just these top 5% of stocks over here on the left. we can start to own more and more different types of businesses in a healthy economic environment. And as a result, cash flow or investor flows move out of a very, very narrow subsect of stocks and into more stocks. And that's how we want to invest our money as things are starting to get better in an early cycle business recovery. Now, we've heard this time and time again that reflation is transitory. It's not transitory right now. Quite simply, we're now in month 8 of this so-called transitory reflation cycle. We see here on the 10-year break-evens, in other words, what are investors and consumers expecting the rate of inflation to be over the next 5 to 10 years? And we can see here there's one common element that whether you're talking US, Germany, UK, Japan, it is on an upswing. And when inflation expectations become entrenched, so do prices. So our job as a portfolio manager is to say, how are we going to invest in businesses with pricing power and can use that pricing power to increase profit margins and ultimately help deliver a higher share price to their investors? That's how we are positioned and focused over the next 6 to 12 months. And we can see here, as those break-even rates have gone up, who makes money in that environment? Well, first of all, the banks do. And we can see here the relative performance of the regional banks, the money center banks, the asset manager firms, investment banking firms. They're all in the upswing relative to the S&P 500. Now, over the very short term, we also want to understand how can we combine early cycle investing with seasonality. There's a few things. You'll notice that in the portfolios this week, we had increased our weight in the home builders. Why is that? Well, from a seasonal standpoint, home builders make almost all of their return between the months of November and March. If you just bought the stocks between March and November through the summer, those stocks are historically flat. Then the vast majority of their historical returns come through the winter months, anticipating that spring selling season. That's one area. The other area is small cap stocks. Now, we don't have a huge exposure to small cap stocks, but we do use small cap indices as a symptomatic approach to understand how the market is behaving and where are we in the business cycle. Small cap stocks outperform historically 2 ways. One, if we are in the early stages of a business recovery, check mark. Number 2, if we're between the months of November and February. Q4 and Q1 are the months that small caps typically outperform. And look what's happening here is that we're starting to see the Russell 2000 break out. And when small caps break out, guess what? The stock market typically doesn't sell off and value tends to outperform growth, and cyclicality tends to outperform secular, even though we think value is actually becoming secular over the long term. To confirm these symptoms, we look at what's called Dow theory. What are the transports doing? If goods are moving throughout the system, if trains are being used more often, if trucks are being used, their capacity is being used, right? Sellers are shipping goods to buyers in a higher degree and more volume, and more units being shipped. That's a sign of health. That's a sign of growth. So we pay attention to how those stocks are doing relative to the rest of the market. And what do we see here? The transports are experiencing a massive breakout. Don't fight this symptom, invest with it, embrace it, make money off it. Second, the rails. The rails are going through a sharp breakout. This is good. That's a sign of health. Embrace it, don't fight it, invest with it, and make money off it. And of course, our big overweight is energy. Energy, quite simply, remains leadership. Yes, there was a Wednesday this week. We were down. Energy stocks took a much deserved breather. That's okay. You want to see that. They can't go up every single day. One of the things our team has been discussing over the last week or so is that some of these stocks appeared a little bit tired. They need a break. Well, they got their break on Wednesday, and guess what? Thursday they resumed higher. So we need to have those reset days every once in a while to give the stocks some oxygen, some breathing space. It's just like a human, right? We can't run forever. We got to slow down, reset ourselves, refuel, and then we continue to run. So we look at the stocks, the percentage of stocks above the 200-day moving average, energy, real estate, financials. These are the most robust, most healthy looking sectors right now. When more and more stocks are trading above their 200-day moving average, that is a sign of health, wide breadth, wide participation across the sector. This is stock market leadership right now. And we see that breakout here in the long-term energy chart with the chart here over on the top right. And we look at flows. Energy flows are nowhere close to where they were in Q1 of this year, where things did get a little bit overheated from a fund flow perspective. Actually, there's a lot of resistance to the energy trade. That's a good thing when you combine it with the fact that it's got extremely wide breadth. And why is energy acting so well? Why do we like it so much? This is, if we look at the chart here on the right, what we see here is the amount of investment going into fossil fuels. It has precipitously dropped, while in green energy, it has gone upwards and to the right. Where's the oversupply? Where's the undersupply? We'll take and invest in the chart here on the right. ESG is the biggest gift that has ever been handed to the fossil fuel industry over the last 20 years. We want to be abundantly clear about that. That's how we want to profit off of that. Now, in terms of earnings here, real quick, we want to invest in what we call double-digit GDP growth. We always focus on GDP at the country level. Hey, US grew 2%. That's fine, but we're not investing in the US, we're investing in US companies. So where can we invest in companies that are experiencing double-digit growth? Well, across the S&P 500 right now, sales growth is around 14.4%. That doesn't happen during a recession. When we look at the earnings growth, it's 36%. The percentage of companies that are beating estimates right now is close to 80%. So again, this is something that we really do want to focus on. And of course, if we look at reported earnings and the percentage of companies beating earnings and beating sales estimates, 82% of companies so far on the S&P 500 are beating their earnings estimates, and 72% of companies on the S&P 500 are beating their sales estimates. What was the other big boogeyman that we heard over the last 3 weeks? Beware the earnings season. Inflation, it's going to kill earnings, it's going to kill sales, the supply shortages. It's not happening. Do you know why there are supply shortages? Because there's a lot of demand. That's the thing. Inventories are lean because there's such strong demand at the consumer level. That doesn't happen during recessions, that happens during expansions. And lastly, of course, the credit markets remain intact. This is something we always talk about every week, good or bad markets, we want to focus on credit. If the lifeline of the US economy and the global economy, the ability of lenders to transmit capital to borrowers in a cost-efficient way remains clear and free of blockages, the economy is going to relatively remain in pretty good shape. So overall, let's ignore the fear mongers. Let's focus on the business cycle and identify stock market leadership. We are in the early stages of an economic expansion. That means we want to focus on economically sensitive stocks, but from a long-term perspective, we do want to focus on value over growth. Why? Because we think we're in a multi-year rally for long-term interest rates. Long-term interest rates tend to tie in with value over growth. Lastly, energy and financial stocks remain durable market leaders. Thank you again for thank you again for watching, and for all of your patience throughout the summer months, and as we continue our recovery here through to the end of the year. If anyone has any questions, please reach out to your advisor and we would be glad to assist. Thank you again and have a great and fantastic weekend.